In this video, we will look at Warner Bros. Discovery. We will look at the recent quarterly report. The stock was down more than 15% on Friday. So we will look at the main reasons behind the recent drop in price. We will look at the total number of subscribers. We will look at the revenue, their earnings, and their free cash flow. We will compare that to previous numbers, and we will also look what management is projecting. We will also look at their debt level, and in the end we will update our fair value calculation of Warner Bros. Discovery. So let's get started. First of all, if you want to get updates about Warner Bros. Discovery, you can subscribe to the channel by pressing the subscribe button under the video. You will not miss a single new video. Okay, if we look at the chart of Warner Bros. Discovery, we can see that the stock was down more than 15% on Friday, right after the report was available. So this is the first quarter when Warner Bros. Discovery reports as a separate company. Before that, it reported as Discovery Communications and Warner Media as part of AT&T. So let's look at the main reasons why the stock was down more than 15% in a single day. First, let's look at the total number of subscribers. We can see that the total number of subscribers of Discovery Plus and HBO Max is 92.1 million. It's an increase of 1.7 million from 90.4 million. Analysts were projecting more subscribers. Also, if you're following Discovery Communications and Warner Media, you can say that previously the total number of subscribers was more than 100 million. It is because that in the recent quarter, Warner Bros. Discovery readjusted the total number of subscribers. 10 million subscribers were excluded. So the total number of subscribers increased around 2% in the recent quarter. I also do not see the breakdown into segments. For example, how many subscribers come from Discovery Plus, cable streaming, and how many come from HBO Max. So they only report the total number of subscribers. Also, if we look at the management projections, we can see that they're projecting 130 million subscribers by 2025, which implies a much higher growth rate of subscribers. Also, it was announced that HBO Max and Discovery Plus will be combined into a single service, and it will be available in the US in the summer of 2023. Okay, so the total number of subscribers was lower than expected. This brings us to the revenue, Ebitda, and free cash flow. We can see that the revenue was lower than expected in the recent quarter, 10.8 billion. The Ebitda for both companies was 1.7 billion, and free cash flow was 789 million. So the revenue, the Ebitda, and free cash flow was lower than expected. This is one of the major reasons behind the recent drop in price. Okay, what management is projecting for the Ebitda to be in 2022? Previously, it was projected to be around 10 billion. Right now, it is 9 to 9.5 billion. The more important piece of info is that management is projecting for the Ebitda in 1 year, in 2023, to be 12 billion. And when I was listening to the conference call, analysts from Bank of America asked, how is it possible that in 2022 the Ebitda is 9 to 9.5 billion and only in 1 year it is 12 billion? So how is it possible? And the answer was that it is possible due to cost synergies and more effective usage of assets. So for me, this brings several questions. Is it possible that the Ebitda in 2023 will be lower than 12 billion? Also, management pointed out that in 2023, cost synergies will be 2 to 3 billion, and in 2024, it will be more than 3 billion. So management is really expecting the cost synergy to happen. They're really expecting for both assets, Warner Media and Discovery Communications, to be more complementary, to work more effectively. Okay, this brings us to the debt level. According to the recent report, they have 53 billion in debt and around 4 billion in cash. So this brings us their net debt to around 49 billion. Also, an important thing to note here is that most of the debt is fixed rate at 4.3%. So if they manage to hit their free cash flow goals, debt not seems to be an issue. Also, it is possible that I will make a separate video about their debt. Again, an important thing to note here is that rising interest rates, if the majority of their debt is fixed, seems not to be an issue. So it is projected that they have close to 10 billion in Ebitda in 2022. and their debt is 5 times Ebitda. So the leverage is 5x. Also, according to management, they're planning to lower the leverage in 2024 to 2.5 to 3x. Okay, knowing this new analyst estimates, let's update our fair value calculation. So these are projections in 2023. The Ebitda is projected in 2023 to be 12 billion. The Ebitda includes 3 billion of cost synergies. The leverage is 4x. It is projected the leverage to be around 2.5 to 3x in 2024, and right now it is 5x. So in 1 year, it is very possible that the leverage will be close to 4x. The free cash flow conversion is 50%. Previously it was 60%. So they have much lower free cash flow conversion. We will use the same EV to EBITDA multiple of 10. This is much lower than Disney and Netflix are trading. So 10 is on the conservative side. So we get the enterprise value of 120 billion. We add back cash, subtract debt, we get the market cap. We divide by the number of shares outstanding, and we get the fair value calculation, which is close to $31 per share. Again, this is a conservative scenario. We used the EV to EBITDA multiple of only 10. Again, Disney and Netflix are trading at much higher multiples. This implies an upside from the current price of close to $14 of more than 100%. Also, this implies the free cash flow yield of close to 17%. So as we can see, even with lower multiples, even with lower management expectations and projections, the stock offers more than 100% upside in the conservative scenario. Okay, has the story changed? I believe that 1 quarter is too early to make conclusions. Market is usually looking not further than 1 year ahead, so it is very important to closely monitor if the situation improves in the next quarters. But if the management is able to hit their estimates, the stock may easily double in the next years. So the stock offers a huge upside potential if the management is able to hit their estimates. So if management is able to come even close what they are projecting, the stock may easily double in the next years and offers a huge upside potential. Also, if you want to know more about the parent company of Warner Media, here is the video about AT&T. If you are not subscribed to the channel, you can just by pressing the subscribe button right here. You will not miss a single new video. Thank you very much for watching till the end, and see you in the next video.